this is a very practical question that we face, because most of us, we got a housing loan that we are not fully cleared, and next then we may have some money coming from bonus or from whatever source. So should we take this money to settle that loan, or to partially settle the loan, or do we invest somewhere? So the question here is that if I get to look at your financial position, look into your cash flow, okay, and then look into the investment experience that you got. If you are someone who have been putting money into fixed deposit, okay, and then say for example, your FD has been giving you only 3% interest rate, okay, so which means to say your money that you put into fixed deposit can only give you 3% return, okay, but the loan, whether it's a flexi loan or whether it's a mortgage loan or Islamic loan or whatever loan, if it is charging you 6% loan interest, then it definitely makes sense for you to take your money that can only give you 3% return to settle the loan that costing you 6% interest, okay. But if you are a good investor, you can invest into property, share market, you can invest into unit trust, and they can give you maybe a return of 9% or 10%. So then for that matter, it is obviously better for you to take the money to invest to get 9% or 10% compared to settle the bank loan, which now are at 6% interest rate for you, okay. But that is a point that you need to consider, because inflation rate may continue to go up, and the bank interest or bank loan interest may continue to increase as well. So it may come to a point whereby the bank interest rate is like now at maybe 9% or 8.5%, and the investment that you are getting is only like giving you 9%. So for that matter, taking the money to settle the loan may be a wiser decision to do. Again, when it comes to insurance policy, it has got different type of insurance policy. Okay, it has got insurance policy that pay you upon your death, okay, then take care of the dependent. But you also have got insurance policy like medical plan or critical illness that protect you yourself even though you don't have dependents, okay. Say for example, in this case, if you are retiree but you may be hospitalized, okay, and should you choose to go to private hospital, then there will be medical expenses incurred. Or if should you, touch wood, to contract into one of the maybe major critical illness, then you may need the insurance company to pay for this treatment expenses, plus also whatever income loss during a period of time. So for that matter, it's very important again to consult a licensed financial planner to really study your financial position, and to study what investment policy that you actually have, okay, and whether this insurance policy is still relevant to your unique situation, or if it's not unique and not needed anymore, chances are you may want to surrender the policy, and then get the proceeds back, and whether you want to invest it or spend it, then you can do that. But study the investment policy first. Why? I think in the first place, I think we need to know EPF also help the EPF members to diversify into not only Malaysia asset class, but also overseas as well, into equity, bond, and also in properties. Okay, so that's why if you were to take money 60,000 from EPF to invest into the investment that can give you capital gain, that of course also a good alternative for you to diversify your investment from main provider EPF, especially if you have got the bulk of your asset in EPF. Also, it's a good diversification from EPF entity. But the question is that, what investment do you invest into? Do you invest into the investment that fulfill the criteria of SRB, or do you invest into the investment that may promise you high return, okay, high capital gain, but fail in all the SRB criteria that I mentioned just now? Then for that matter, I would suggest you to make sure that if you decide to take the money from EPF to invest, make sure those investments that you select fulfill the criteria of the SRB standard.